credit growth exceeded deposit growth last year, and that's a trend we see now over the last couple of years. So over the last 5 years, on average, credit growth to the private sector has grown by about 13%, and deposit growth has been clearly lower. Now, on the credit side, last year, the main driver for credit growth was corporate loan demand, whereas in the years before, it was primarily residential mortgage loan demand. And this corporate loan demand, I expect, will continue to be the driver also in 2025. So I expect in 2025 this growth momentum to continue in terms of credit demand. I expect credit demand to be, again, around 12 to 13%, mainly driven by corporate loan demand. And that has to be seen against the backdrop of a very strong domestic economy, non-oil economy, and the increased need to finance all the Saudi vision initiatives and the projects which need to be adequately financed. That will lead to elevated growth rate also in 2025. On the deposit side, growth will be a little lower. You mentioned that. Last year it was about 9%. Longer term, we are about 8 to 9%. I don't expect this growth to accelerate, all the more as part of these deposits are owned by government institutions. And government institutions in the past, they have shifted their deposits from SAMA balance sheet to the corporate, to the commercial banks, in order also to help fund the commercial banks. These government institutions, they incrementally now need also liquidity to finance their projects and their initiatives. Hence, that's a cap on growth for deposits. So I see the deposit growth for Saudi banks in the range of 8 to 10% in 2025.
So would that translate into pressures on the margin of Saudi banks?
Yeah, that's a good point. I mean, we see that now over the last couple of years that credit growth is exceeding deposit growth. That means that Saudi banks have been increasingly requested to find alternative sources of funding, and that's what they already started to do. They have primarily tapped capital markets, borrowing locally, borrowing internationally by issuing sukuk, Tier 1 sukuk in the first place, which is hybrid equity capital in the balance sheet of these banks. And that will continue in 2025. So you will see banks continue to issue sukuk to fund their credit demand. And obviously that has an impact on the funding costs. Funding costs go up. Somehow mitigated by the fact that interest rates overall will decrease. They already started to decrease. 3 months SAIBOR is at 5.3% at this point, after 6% last year. We see 3 months SAIBOR to drop to 4.7 end of this year, 4.2 end of next year, and that has that constitutes a certain relief on the funding side for the banks, all the more as when interest rates drop, then you typically see a shift from interest-bearing deposits to non-interest-bearing deposits, and that has a softening impact on the funding costs for the Saudi banks. However, taking everything into consideration, also on the credit side, net interest margin will be compressed in 2025, but overcompensated by this very strong credit growth I expect for this year, which means that profits of Saudi banks will nevertheless grow by about 10 to 12% this year.
Dr. Hans, let's discuss the Saudi market. We haven't seen major movement in the market. What are your thoughts on the current valuations of the stock market?
Yeah, as you correctly mentioned, the Saudi market is in a consolidation period since almost 12 months, since spring of last year, moving somewhere between 11,500 to 12,500 points in terms of TASI, Tadawul All-Share Index. At the same time, we have seen earnings starting to recover last year. and that has caused valuation metrics to ease. That means PE ratios have declined on a trailing basis, on a forward basis, and currently these PE ratios are about 7% below their long-term average. So that means the Saudi market, I wouldn't call it is outright cheap, but it's very moderately valued. Now, if you consider that we will see continued corporate earnings growth in 2025, that's what we expect. We actually even expect a certain acceleration of growth that overall constitutes a positive and constructive fundamental environment for the Saudi market. In the medium to long term, short term, there will be some volatility, also influenced by global markets, by increased political and economic uncertainties which are waiting on global markets, and that also influences the Saudi market. From a longer term perspective, I think we can be constructive. There is a very dynamic domestic economy, there is earnings growth, there is moderate valuation. And finally, I think that the Saudi market is still under-owned by foreign investors. The free float ownership of foreign investors is at 11% in the Saudi market. That compares to 25% internationally. And that gives quite some room for future capital inflow by foreign investors, which will help to bring the market to the next level, to 13,000 points in terms of TASI and above in the medium term. That's basically my scenario for the Saudi equity market.
An interesting story we were following in the Saudi market is the dividends of Aramco. The expected dividends for 2025 is less than what we have seen in 2024. What is your assessment on the impact of that on the Saudi budget and on the economic outlook?
Yeah, the dividend of Aramco will be about $85 billion this year, as opposed to $124 billion last year. But Aramco made it clear that part of the dividend is performance linked, and we knew what happened in the global oil markets in the last 2 years, so it was not a surprise that the dividend will turn out to be lower. So, of course, that has an impact on the fiscal budget of Saudi Arabia. The deficit, I believe, will be somewhat higher. It will be above 3% this year. And there will be also deficits in the coming years, but that's what the government itself already projected. In my view, Saudi Arabia can afford to have some deficits in the next couple of years because the debt to GDP ratio is still relatively low. The key point here is that the money which is borrowed on capital markets is used to foster growth and to support the transformational process of the Saudi economy, which will make that the Saudi economy will be better off in 5 years from now, even at the expense of a somewhat higher debt to GDP ratio compared to now.